Hey, Roy, Dr. Joe's in the house again, live on this Wednesday evening for another Wealth Wednesday. It's going to be a good session, I think. We're talking about money, raising capital, and the changing times that we're in. There's no longer easy money anymore. I'm sorry. But trying to get money from banks, private investors, and all these other agencies is not as easy as it used to be. And so I wanted to kind of delve into that and some of the strategies that you and I, can do as we enter this changing environment. So let me get the folks down on Instagram on board first. Just one second. And I think we're going live now on Instagram. So, okay, let's have a look. Okay, so I'm back on and so on. So let me get myself settled. And it's all about the money. Okay, so just a heads up as usual. If you have any questions, please, or questions for me, put them in the chat box and I'll get to them about 20 minutes from now. Anything to do with real estate investing, obviously that's fine. And if you want to book a one-on-one with me, you can go to my website, joeasamoah.com, www.joeasamoah.com, and you can schedule something there with me. I will be traveling this weekend. Yes, I'm off on a cruise for 7 days. We're flying to San Juan from the US and Puerto Rico, and then from there we're taking a 7-day, well, I suppose it's 7-night, 8-day cruise to various Caribbean islands, St. Kitts, Antigua, Martinique, Barbados, St. Martin, and a few others. So I was looking forward to that one, and all set for that one. And I will be traveling to Ghana next month as well for 3 weeks. We're going over there to, I think I'm going there February the 24th, I think, for 3 weeks. So I look forward to that. That'll be 2 trips overseas for this year so far, and 4 more to go. Anyway, less about me, more about you guys. So today we're going to talk about raising capital, and all the sort of all the activities associated with that in this new environment. So what do we? Okay, let me kick it off. So the capital you need is still out there. Money's still out there, yes, definitely, but it won't be easy, to get as it used to be in the past. The reality is that if you ever had a strong deal but felt that capital didn't come through together the way you should have, quote unquote. A lot of people experience that. So for many residential real estate investors, frustration isn't the lack of opportunity; it's the growing disconnect between, good deals and the available capital. Properties, you've done your analysis, you found the deals, you've spoken to wholesalers, you talked to real estate. It's all looking good. It cash flows. The demand still exists for your property. The long-term fundamentals still remain intact. Yet the ease with which money was once was moved has kind of disappeared, I suppose. Many investors are discovering that capital hasn't just vanished; it has simply become more selective. Okay, the money's out there; it's just more selective. People are more cautious, and far less forgiving. Especially if you have a weak execution, if you don't have your systems together. The past few years has reshaped investor psychology. I've been listening to quite a few podcasts. A lot of people are kind of struggling in real estate right now, especially fix and flippers and wholesalers, and the market is very, very soft. And so, because of that, I mean, I think I recall probably a year or two ago, when people were just able to raise money. There was just a lot of money floating around, and that is not the case at all. People are discovering that capital, it's just harder, and especially the people with money, their psychology has changed. Higher interest rates, slow down sort of the velocity. Tightening underwriting requirements has exposed, if you got a fragile deal, And also private capital. That's another one. Private capital has become a lot more discerning. After a lot of people, especially syndications, have just gone belly up, and a lot of people have lost their money due to marginal deals, especially in the larger space, like apartment buildings and commercial buildings and things like that. So, you know, capital providers, which in this context of here are things like banks, hard money lenders, and individuals alike, have become, a student of risk and not just seekers of yield. So it's not just about trying to get the max yield. It's about making sure that you you sort of allay the risk that's out there. And so the casual confidence that once carried deals across the finish line is no longer enough. This sort of shift has created a kind of a divide. On one side are investors who are sort of stuck with the old strategy, wondering why calls to lenders go unanswered and commitments fall apart. But on the other side are investors who sort of recalibrated, figured out that times have changed and they've changed their strategy, and they've learned to communicate differently, structure the deals more thoughtfully, and treat capital raising as a core competency rather than an afterthought. So the difference between the two isn't intelligence or experience, it's an adaptation. So as usual, I'm going to break the session down into 6 parts. And then after each one, then we'll do the conclusion, and then we'll have the Q&A with Ask Dr. Joe. Okay, so 6 parts I'm going to break it down into. So the first one is the market has changed, and it's not going back. It ain't going back, at least for a while, unfortunately. So the question is, are you waiting for capital conditions to quote unquote normalize? Or have you accepted that this is the new normal? So many investors initially, treated high interest rates and the tightening lending as a temporary disruption. We thought that, things are going to change. It's going to get back to normal again. Just, go through a little rough patch. So they delayed decisions, hoping that the environment will kind of revert back. But, time has revealed a harder truth. And that is, this shift is structural. It's structural. Okay. Lending standards are stricter. I don't know if anyone's trying to get money these days. It's not as easy. It's stricter. Lenders, because a lot of lenders were burnt. And private investors, they're a lot more cautious now because they've been lied to. They were given empty promises about all this yield they're going to make, and didn't materialize. And many deals unraveled. So capital now demands discipline as the price of entry. Okay, investors who succeeded were the ones who stopped fighting the environment and started operating within it. They realized that this is the new normal. They re-underwrote deals using conservative assumptions, adjusted their rate of returns, and built-in margins for error. Things don't always go as planned, and so they put that into the plans. So they stopped forcing deals to work and instead focused on deals that could survive a certain level of stress test. Okay, so it's not really pessimism. It's just the reality. Those who failed often ignored the warning signs. They relied on financing and never materialized, assumed appreciation will kind of cover their mistakes, or underestimated how long capital will remain tight. So when the exit strategies collapsed, so did the investor confidence. The lesson was painful but clear. Markets don't reward denial. Okay, accepting the new landscape doesn't limit growth, it protects it. Investors who adapt early, hopefully you, gain credibility, stability, and longevity, while others burn out chasing a past that no longer exists. That's number one, and that is the market has changed and it's not going back. So let's go to number 2, part 2, which is credibility is now more valuable than capital. Your credibility becomes very, very important in this new environment. And the question is, I suppose, is if an investor hesitates Do they doubt the deal or do they doubt you? The investor here I'm talking about are the people with the money. So if the person with the money hesitates, are they doubting the deal or are they doubting you? Okay. In a cautious market, investors, which are the people with money, are funding people before projects. They're funding people before projects. Listen to that. Funding people. They're looking at you before they look at your projects. Numbers matters, but trust matters more. Credibility today is built through consistency, transparency, and demonstrated learning. You've done it before. Okay. Investors who know, how you think, how you respond under pressure, and whether you can be trusted when outcomes deviate from the plan becomes more important. Many failed capital raises shared a common flaw, and that is the operator oversold confidence and undershared the risk. They talked about all the good stuff, but didn't really address uh, you know, the potential problems. So when reality intervened, communications broke down. They didn't call people. They kind of went underground, went MIA. In contrast, successful investors normalized honest conversations. Communication becomes very important. They spoke openly. We speak openly about what could go wrong, what has gone wrong, what's going wrong, and how we plan to respond. This candor, it really doesn't scare investors. People with money, it reassures them that you've got things under control, and it builds credibility. So each clear explanation, each proactive update, and each honest acknowledgement strengthens your reputation. So in tight markets, investors remember who told the truth early, not who promised the most. It's who tells the truth and not going to give them the world and you can't deliver. So that's number two. Let's go on to number three, which is clear deal positioning and complexity losers. Okay, so clear deal. You got to have clear communication. You got to be able to articulate your deal. It's got to be simple, understandable, and not necessarily too complicated. So the question is, can you explain your deal simply enough that an investor trusts it? And here, the context is the investor is the person with the money. So, can you explain your deal simply enough that the person with the money can believe you? Okay. So, when capital tightens, complexity becomes a liability. Overly intricate deal structures, complicated things, unclear assumptions, and shifting projections signals risk, even when the deal itself is sound. So, investors today are looking for clarity, not cleverness. You have to do some fancy stuff. Successful investors learn to position deals around fundamentals. And what are the fundamentals? Cash flow, resilience, downside protections if things go wrong. How are you going to cap your downside? And execution capability. How are you able to execute? They stopped lending or leading with upside and started leading with survivability. Are you going to be able to survive in this environment if things go wrong or things becomes unplanned? Okay, so this reframing aligned with how investors now evaluate opportunities through the lens of preservation first and growth second is really important. Deals fail to get funded when investors feel confused or rushed. When the people with the money get confused or rushed, you're too anxious because you're running out of time, they can sense it in you and they're probably going to back away. So, clear positioning isn't about dumbing things down. No, it's about respecting the investor's needs for understanding and control. So that's number three. We're kind of halfway through. And as usual, if you got some questions, please put them in the chat box. I'll get to you in about 5 or 10 minutes. And anything to do real estate. And if you want to book a one-on-one with me, you go to my website, www.joeasimo.com, www.joeasimo.com, and you can book a one-on-one with me for an hour or so. I just did a good one yesterday with Dave. He bought his house up in Washington, D.C. He's got his tenant lined up now. So good job, Dave. And hopefully everything's going to be successful. This is his first house in Washington. He's been doing some other stuff in other cities. and so on. Okay, so let's go to number four. Number four of six is capital is no longer raised. Not raised, it's cultivated. Cultivated. Mm. So the question is, are you building capital relationships continuously or only when you need the money? Are you just doing it when you need it, or are you doing it continuously basis? Okay, I suggest you do it on a continual basis. Reactive capital raising is one of the most expensive habits an investor can have. When relationships are transactional, then your leverage disappears. Your credibility disappears. People are looking for, the investor, they sense in you a sense of urgency, and urgency, desperation, weakens your negotiation power. Okay, those who succeed replace randomness with rhythm. They maintain investor lists, they sent regular updates, and treated communications as a long-term investment. It's all about relationships. Okay, so they maintained the investor list, they sent regular updates about what they're up to, what they're doing, and they treated communications as a long-term investment. Capital became a system and not a scramble. This sort of shift reduces stress and increased confidence. Yeah, when opportunities arose, capital conversations or money raising conversations were already warm. It wasn't, something that just starting from scratch. It's something that you've nurtured over a period of time. Investors funded deals not because they were pressured, but because they were prepared, not pressured. Okay. That's number four. Let's get down to number five. And number five is it's all about fair structures attract long-term capital. Fair structures attract long-term capital. And the question is, would you feel protected if you were investing in your own deal? Would you invest in your own deal? If you had the money. That's a good question. Investors today scrutinize alignment more than ever. Deals that heavily favor operators, i.e., the person doing the deal, without acknowledging investor risk, struggle to get funded. Okay. So it's got to be a win win for all parties. It can't be a win for you and they taking on all the risk. It ain't going to happen. Successful investors design structures that feel balanced, transparent, and also respectful. Failed deals often reveal misalignment only after challenges arose. So when expectations weren't set clearly, trust eroded quickly. Okay, investors who succeeded anticipated these moments and structured accordingly. So what do I mean by that? Fair doesn't always mean equal. It means understood. Take the time to explain that everybody understands what it is that you're trying to do. When investors believe the structure is honest, they can stay engaged even when timelines stretch. When things go wrong, they'll still stay engaged because you are communicating, you've been honest with them, and it's all about creating win-wins. And finally, number six, emotional discipline is a capital strategy. Emotional discipline is a capital strategy. What do I mean by that? Well, the question is, does pressure show up in your capital conversation, your money raising competition? Does pressure show up? Do you look desperate? Capital is intuitive. Okay. Investors feel desperation. These are people with money. They feel desperation even when it's unspoken. Many failed raises occurred not because the deals were bad, just because the timing was poor and the pressure was high. They could sense it in your voice. They could sense it in your presentation, your style, your mannerisms, and so on. So successful investors cultivated emotional discipline. They raised capital early, maintained financial buffers, and walked away from misaligned money. Okay, so calm leadership created confidence. In today's market, patience is not passive, it's strategic. Investors who manage urgency also manage outcomes. So, in conclusion, wrap it up. It's now 7:23, which is good. Let's wrap it up. So, capital didn't disappear. The bar was raised. The bar was raised, and it's still out there. So the question is, are you prepared to meet capital where it is now, not where it used to be? So, in summary, the investors who continue to grow understand a simple truth. What's that truth? Capital still flows, but only to those who have earned it. Okay, the new environment rewards clarity, discipline, and credibility, and not shortcuts or assumptions. Okay, this shift is sort of filtered out the weak operators while strengthening resilient ones. Hopefully, you. Okay, so those who adapt don't just survive, they gain trust, leverage, and long term opportunity. And that's why this conversation matters. Okay, it's very important in this new environment, and real strategies that help residential real estate investors like you and I keep building on no matter what the market is. So, yeah. Oh, I forgot to mention this month, in fact, last week, my longest tenant uh, was 29 years. 29 years. She's been with me. Amazing. We moved in another tenant last Friday, a house in Maryland. So congratulations to Reba. Welcome to the family. And she has a 6 bedroom voucher here this is in Maryland. And look forward to hopefully she'll be there a long time, a long, long time. Anyway, that's it for today. So let's get down to the Q&A. But if you got some questions, please put in the chat box, and I'll get to them in a second. And as always, if you want to email me, you can shoot me an email at joe@joeasimo.com, joe@joeasimo.com. And if you want to book a one-on-one with me, Zoom meeting, you can go to my website, www.joeasimo.com. That's www.joeasimo.com, and you can schedule a one-on-one. I will be traveling, as I said, this Saturday for a week, or 8 days, I suppose. And looking forward to spending time in the Caribbean, get some decent weather, and go on a cruise. So this one is on the Virgin cruise line. I haven't been on that one before. Virgin is like this British company, Richard Branson. They have a Virgin Mega or Voyager, I think they call them. And so I haven't done that one. It's an all adults cruise. So that should be interesting. And so on. So I look forward to that on Saturday. And so maybe I'll send some photographs and do some social media posts. You can see what I'm up to when I go to these different islands, 5 different islands. Okay, then I'll be back the 25th, and then off to Ghana later on in February. So it's going to be an interesting year. Okay, let's get down to the questions and see what we got today. Hey, our Dao2 in Phoenix. Greetings, regular. Hope you're doing well in Phoenix. I'm sure it's a lot warmer there than it is over here, and so on. So this one's Nestacam 2128. Let's have a look. Let's have a look. I think I'm an out-of-town investor from Brooklyn, New York. I have a rental property in St. Louis, Missouri. It's a hassle going back and forth and people not showing up for their schedule. I'm sure it is. It's a big hassle because I wouldn't like it. So my first option is to use Section 8 for my rental property. However, if I decide not to use Section 8, I plan on using a property management company. What do you think, Dr. Joe? Yeah, I have mixed feelings about property management companies. I haven't found anyone that's any good, but that's just me. But there are some good ones out there. It's just that you have to, take your time to find them. If it's a hassle going from St. Louis to New York, oh my goodness, just to show a house, because people don't always show up when they say they're going to do. So I know we've been talking about this for a while, Nesta, but essentially what I would suggest is I certainly don't like to go to show a house just to one person. So if you're going to go to St. Louis, I'll try to schedule as many appointments as you can while you're there. So you market aggressively and prior to your arrival, and before you on the day of arrival, or before you want to kind of check in with people to make sure that they're still interested, making sure that they're going to come, and so you want to text them before and also follow up with them on a regular basis. That's number one. In terms of management company, it may make sense for you because of the fact that it's just the distance. So in that case, then you want to find a management company that has experience with Section 8 if you want to go that route. You want to check some references of the management company to make sure that they have a good track record. And also, you may want to, because some management companies, it's all about getting bodies into a house. And I think I told you the story where my brother had a house in Maryland and he gave it to a management company. And like clockwork, every year there was a turnover. And after a while, he just said, "This is too expensive," because turnovers are very expensive. So he asked me to, if I was interested in managing it. I didn't want to do it first, but I agreed to. And so I did what I do. I got a tenant, and the tenants were there for 22 years. So, but when the management company was doing it, they were there for a year, and so on. So it's the same house, but we're getting completely different results. So what does that mean? Why is that? I just took the time to find quality tier one tenants who loved the home, had a great track record. They're looking for a long-term stay. It wasn't just about getting a body into a house. So I did the thorough screening and we selected somebody and they were there for a long time. Because as a landlord, turnover is very, very expensive. Whereas for management companies, turnovers can be a profit center. They can make money because they're going to collect another security deposit. They're probably going to do a markup on the charges from the repair company or the contractors. So the contractors may charge one price and they tax something else on it. So it becomes a profit center. So, they have a different agenda, in other words. And that's the reason why it's really, really important to do your due diligence, get some referrals, get some recommendations. Maybe go to different forums like Bigger Pockets and things like that. And find out if there's anywhere that can recommend management companies in the Missouri area that may have experience with Section 8 and things like that. So I'll definitely do some due diligence. I'll speak to property management companies. May want to speak to real estate agents. You may want to speak to appraisers. In the local area, they may know some people. And but it will never be or should not be a hands-off thing. At best, it's going to be your involvement in quote unquote managing the managers, as opposed to just letting them assuming that they're going to do the right thing. No, absolutely do not do that, in my opinion. So it's not going to be easy, but it's doable. And but yeah, I think it's time to put some systems in place in terms of if you're going to show it yourself, then obviously that's one thing. Line up the marketing, line up the the showings, and so that way you can try to have several or multiple showings. Also, you may want to consider the house. Why aren't you getting applications? Is there something wrong with the house? Is there something going on in the neighborhood? And that could be an issue. I stage my homes. I'm not saying that you should do that, but I try to differentiate my products, my homes, from my competition, because you do have competition. And what you need to be asking yourself, Nestor, is why should somebody want to move into my house versus go with somebody else? Okay, so what differentiates your property from others? And it could be the messaging, it could be the marketing, it could be the platforms that you're in, it could be lots of different things. And you may want to explore some of those. And if it makes sense or you're not having much success, then it could be worthwhile to then maybe do your due diligence and find a quality management company who can do it for you. Okay, hopefully that was helpful. Let's have a look. What have we got here? Where is it better to fix and flip? Which markets? I know it's harder right now, but it's not all bad. I'm not a fix and flipper. I'm a buy and hold guy. It's the market shifting, which means that you have to be a lot more conservative in your numbers. You definitely want to try to buy it right. You certainly don't want to overpay. You want to buy it in such a way that it's under market value, and the numbers make sense. You have a good team that can pull the renovations pull it off. Make sure that they know what they're doing. Make sure they can get permits. Make sure they can get through inspections. And you may want to shop around for capital at a cheaper rate, the cheapest you can get it, because your holding cost becomes very important. If you have a contractor who doesn't do their job, something that could take 1 month is now 2, 3, 4 months, and you still haven't implemented your exit. So just be cautious. I'm not saying don't do it, but definitely be a lot cautious, because you can't assume that the market is going to bail you out. You can't assume that if things don't go right, someone's going to pay more money for your home. You can't assume that at all. There are three things that you do control, or two things really. You control what you pay for the property. You, to a certain extent, you can control your costs during the acquisition renovation. You really don't have much choice in terms of the selling price, because that depends on the market. So the best thing to do is to try to contain your costs, which means that you buy it at a very affordable price, and you also um, track and manage your expenses once you own the property. In terms of which markets, I don't know. I mean, I'm not a national player. I'm very focused in the Washington D.C. area. The market here is also soft. So I know there are some markets that are stronger than others, and but I'm not an authority on that, so I really can't say. I would probably first of all start off with where you live, or close to where you live, as opposed to trying to go long distance. Because if you go long distance, there's nothing wrong with that. It's just that you're not there. And just like what Nestor was saying, it's hard when you're far away and your property is not something you can drive to or walk to. You're at the mercy of other people, and which means that you have to take control and do your due diligence on people, because people have their own hidden agendas, and their agenda may not be yours, or in sync with yours as well. Okay. Nestor can. I know the property management companies don't care about your property the way you do. They just want their 10%. I will do a thorough background on the tenant that they select. Yeah, that's a good idea. If you can have them maybe identify one or two or three potential prospects, and they can come up with some recommendations, and then I would possibly reach out to them and speak to them, and make sure that that tenant or that prospect is in line with yours. And do they have the same goals? Do they have the same outlook? Are they looking to stay a long time, or they're looking for a 1 or 2 year thing? So yeah, it's a little risky when you go to management company. I mean, people do it all the time. So I'm just a lot cautious, because I just haven't had any good experiences with management companies. But it doesn't mean that they're not out there. They're out there, and you just have to take your time to find them. Let's have a look. Let's see if there's anything on Instagram. I got a few people on Instagram. Kevin Asamoah. Huh, interesting. What's your perspective on real estate as a long-term form of capital preservation? What do I think of real estate? Well, I think very highly of real estate. I'm a long-term player. So I believe that real estate can help, can work, does work, especially the Section 8 play. And the reason why I like the Section 8 play is because I like the guaranteed rent that's associated with that program. As long as the tenant's in the house, you're getting paid, and you cap your downside. So if the tenant doesn't pay you, you still will receive the government portion. And if the tenant loses their job, um, you know, they just go off to the housing authority, and they can get their rents reduced. So that's the reason why I've been able to survive through multiple market cycles. And that's the reason I've been able to survive when people lose their jobs. And since the tenants don't pay all the rent, they tend to stay longer, especially if you treat them right. Make sure that you focus on customer satisfaction, customer happiness, and things like that. So that's been my experiences. It took some time for me to get to that point. With Section 8, I made all the mistakes that everyone's made. I've had tenants from hell and drama queens and things like that, but I've been able to work through some of those things. And now I realize that what works for me are what I call tier one tenants, attracting, retaining tier one tenants. I know who these people are. I know what they want, where they want to live, where they don't want to live, who they want to rent from, who they don't want to rent from, what kind of house they want, what kind of house they don't want. I mean, I have a good idea of who the customer is. And therefore, I've sort of oriented my business completely around that. And that's the reason why I have 20-year, 25, 29-year, 18-year, 15-year tenants consistently. And that's not to brag or anything, because that's not necessary. It's just that if you do this right, it's a great business. It's a wonderful business. It can help build financial freedom, cash flow, tax benefits, appreciation, equity buildup, on all those things that I think real estate has to offer. Okay, let's have a look. It's now 7:40. Okay, I think I'm going to wrap it up for today. It's been a good session. Hopefully today was helpful. Again, if you want to shoot me an email, I can reach at joe@joeasamoah.com, joe@joeasamoah.com. And if you want to book a one-on-one with me, you can always go to my website, www.joeasamoah.com, and you can do a one-on-one. Otherwise, next week I won't be in town. I won't be in the country. So there will be a replay. I'm not too sure which one it is, a replay for next week, but I'll be here the week after, which will be the 28th of January. And I'll be here with another subject, and looking forward to that one. So again, I hope that you have a wonderful, let's have a look. We've got one more here. Let's have a look. Katie. Hey, Katie. Hi, Dr. Joe. Happy New Year to you. Have you been seeing any changes in ease confidence of lenders with all the recent Section 8 administration policy changes? Yeah, lenders are definitely being a lot more cautious. It's not easy to get money. Some lenders are pulled back. I know a lot of private investors are pulled back. They're just a lot cautious. They hear the news. They hear people, the economy is not doing that great. They hear that government's funding is being cut. There are definitely changes in Section 8. I got an update from DC Housing Authority, I think last week, that they used to pay security deposits for tenants. They stopped doing that now. So there's things that's going on too, in order to save money, to live in the new reality of budget cuts. But that's the way it is. It's still a lot of opportunities, and the demand is still there. The supply is still weak, and the opportunities are there. What can I say? And so I think it will be fine. We'll get through it. And but it does mean that you got to have systems in place. You got to know what you're doing. This is not the time to wing it and just cross your fingers and hope for the best. Those people who are winging it will get wiped out. But those people who put the right things in place and hopefully implement some of the suggestions I'm making, hopefully we'll be on the other side. We'll be surviving, and not just surviving, but thriving. This is a good time to buy if you have the ability. It is the best time to buy because you can negotiate hard. Sellers have the upper hand, and sellers, buyers have the upper hand, and so you can negotiate some pretty good deals if you have the money, if you're able to execute, you have the systems, relationships, and the processes in place. So yeah, this is the time. But it's not going to be easy, but it's definitely a good time. Okay, my friends, it's 7:43. I'm going to wrap it up for today. I'll see you on the 28th of January, not next Friday, not next Wednesday, sorry, the Wednesday after. I'll be in sunny Caribbean, enjoying the weather, enjoying drinks, partying, and all that other stuff that people go on cruises for. So I'll see you in a couple of weeks, man. Take care. Take care. Bye for now.